Hey, welcome to my live stream. This is Victor H. And in this live stream, I'm going to be reviewing stocks that are interesting. I'm going to be primarily looking at my watch list and kind of cleaning it up a little bit. I see that I've got a lot of stocks in my watch list, so I wanted to clean it up, maybe take a few names off, and I needed to complete a full evaluation of a couple of stocks in that watch list. So I thought I'd do that with the community and go through some companies that I think are worth considering for my portfolio. So I'll go through my watch list, clean this guy up, see what that's all about. If you have a stock that you want to talk about, please put it in the chat and we can definitely take a look at it. And let's see how long we can go. It is Monday night. It's December 23rd. And tonight there should be a football game unless they canceled it, but I don't think so. Football game will probably start in about an hour. And I could watch that in the background and take a look at some stocks. So the market was down for part of the morning, but then it recovered. The NASDAQ did quite nicely. It was up 0.98%. The Russell lagged. Small caps lagged today. S&P did well. And then the Dow was up just a little bit. In the morning hours, it was struggling. So it's just interesting that it recovered. All right. So I wanted to look at two stocks that are looking a little iffy in my portfolio and then get into my watch list. And the first one that's looking a little iffy is Cisco Systems. And Cisco is a technology company. They've been around for a long time. They actually helped build the internet way back when in the 80s and 90s. Cisco was the best networking equipment manufacturer, developer in the market, and they did quite well. Nowadays, they find it hard to grow. You can see that their revenues have been contracting a bit over the trailing 12 months as well as the full fiscal year 2024. In the quarterly, you can see that 4 straight quarters of declining sales. So that's not good. Now, the stock over the 5-year chart, the stock has had ups and downs. And I was able to get some shares and really see those shares go up in value, which is good. But the stock's not really punching through kind of like previous highs. I'm thinking it might be a stock that I could just take off my portfolio and call it a win and move on. So let me take a look at it. Krishna V, thanks so much for joining. Looks like you want to look at MEDP. We can definitely do that. Give me a few minutes to finish my thoughts on Cisco, and then we'll get into MEDP. Thanks for joining. All right, so Cisco Systems, we're dealing with a company that isn't growing a whole lot, and they pay a dividend. Dividend's pretty nice. It's a buy according to analysts, but it's fairly priced. And when I look at this company, it's not growing a whole lot. Their margins are fairly good. Their gross margins are at 65%. That's very good. So that looks good. Free cash flow looks very good. Although in previous years they had done better, their free cash flow looks okay. When I value the company using both free cash flows and earnings per share, I find that the stock is fairly priced. So since I don't think it's punching through the upside, I think I'm going to be selling my shares in Cisco tomorrow during the trading day. The reason for it is, I bought it at the right time. I'm going to make about 20%, and I haven't held the stock for more than 6 months. So that's a good win. And I just think Cisco isn't growing enough to really be an exciting stock. And I'm glad I picked it up, but it's time to move on. So I'm going to be selling my Cisco shares tomorrow morning. I'll put that into my plan. So hopefully you've had a good day. The market was up nicely. My portfolio went up nicely today, which is good. So this guy, we're going to put a little red on it and plan on selling tomorrow. All right, so we made a decision on Cisco. Now let's take a look at a couple stocks that Krishna wants to talk about. You got a couple here, right? So let's start with MEDP. MEDP. So that's MedPace Holdings. And these guys provide clinical research-based drug and medical device development services in North America, Europe, and Asia. The company offers a suite of services supporting the clinical development process from phase 1 to phase 4 in various therapeutic areas. So they do the services to help a drug company go through the whole process of getting a potential drug through the steps and make it commercially viable. So that's what they do. That's interesting. 5-year, wow, this has been a great stock. It's up to 10.5 billion. It's really rewarded investors over the 5-year, 301% up. That looks really good. For the past year, it's pretty flat, 8.73. So it had a phenomenal 5-year. Things are slowing down for it. Curious to see over the 1 month, not much. And then the 1 year, 8.73. The company has revenue of $2 billion, PE ratio of 29 in the current year, and then the forward year will be 27.68. Analysts think it's a buy. It's discounted by 14.73%. Let's take a look at growth. So I like to see revenue growth. Revenue growth tells me that the company has good products that are in demand, so much so that they're getting more customers. Customers are buying more products from the things they offer. And it looks like there's green on the screen. It looks very, very good. Looking at the quarterly, the revenue continues, although it's slowed down a little bit in Q3, slowing down to 8.29, but still it is green. I like growth. Not bad at all. It is slowing down a bit, so maybe that's causing the 1-year performance not to be great if the sales are beginning to slow down a bit. Having said that, let's take a look at the gross profit and free cash flow. Most valuable companies have high gross margins, high free cash flow, and these guys have a nice gross margin level. 67% is very good. Very good gross margin. And the free cash flow, it's good that they've grown it. I always like seeing that there's growth over time on free cash flows. So this is a growing company, and I would value them at around 10 billion, maybe 15 billion, 10 to 15 billion based on free cash flows. And that's going to depend on the balance sheet, how much cash and debt they have. So the debt is very little, cash much higher. So they have a very strong balance sheet where they have plenty of cash to pay off all the debt that's on the balance sheet. This is a strong business, strong stock. They are fairly priced. Now you can argue that, hey, it's discounted because they're going to grow. And I would agree with you, but I would say that they're worth 10 billion, very conservatively, 15 billion if they're going to continue to grow quickly. How do I get there? I get there by taking their free cash flow. And since it's a growing company, I would multiply times 20. And their free cash flow is 535. If I multiply that times 20, I get to roughly $10.7 billion. And if I multiplied time, let's say 25 or so, then I get to a higher valuation. But that's what's getting me to that 10 to 15 billion in valuation for this company. This is a good business. One thing that's been occurring in the healthcare spaces, healthcare's had a tough year. You could see that in previous years, these guys were just doing really well. Stock was really moving upward. But now it's been trading somewhat flat. 8.73. That's not bad, but this is an interesting stock. Not a bad stock at all. They're in a good space. They offer services in a area that's going to be consistently in demand. The development of drugs would just continue to exist. It's not going away anytime soon. So that is MedPace, really nice company. Thanks for bringing it up. It looks like, Krishna, you're interested in a couple more. EBBTY, and then MSCI. Okay, let's take a look at those. Axel, thanks for joining. What do I think about Tesla? Yeah, let's take a look at Tesla and GM. And you know, those are interesting stocks to look at, and we'll get into them in a bit. I'll give you my comments on those companies. Okay, so MSCI. So EBBTY. EBBTY. All right, my internet's a little slow, or the application's a little slow, one or the other. Looks like some other people have joined. Thanks so much for joining. It looks like Anirude. You want to look at NUE. We can look at that. We're going to look at Tesla and GM. Let me try this browser here. See if this one's going to work better for me. All right, here we go. So this company develops, produces, markets, licenses online casino systems to gaming operators in Europe, Asia, and North America. Okay. It's small cap, 15 billion, revenues 2.3 billion. PE looks really reasonable at 12. Forward PE not available. Okay. And what country are they in? So Krishna, what country are these guys in? All right. So they've been growing really nicely. Revenue's really good. Yeah, revenue looks really good for these guys. And when we look at their gross margins, so they license everything, so they don't have to produce anything. That's why it's 100% gross margins. Looks really good. And it looks like this company is headquartered in Sweden, huh? Okay. And free cash flow, man, these guys look great. Free cash flow has expanded really well. Okay. And based on their growth, I would value these guys at, well, let me look at their balance sheet first, make sure they don't have a bunch of debt, which would sour my liking for this company. And it looks like cash 740 million, debt 91 million. So they have lots of cash, very little debt. Excellent. Okay. Having seen that, these guys are probably going to be worth 25 to 35 billion dollars. They're currently market cap's 15. So these guys are nicely discounted. They're a Swedish stock, which, let me make sure I didn't. So this is a euro. Okay. So the euro and the dollar are close to each other. They're not too far from each other. So this looks like a really good stock. This looks like a good company. I like companies that have intellectual property as their product. You saw their gross margins being at 100%. I mean, that's excellent. So this is a good one. It's a really good one. So the first one was okay. The second one, EVVTY, is excellent, and I would consider starting to watch that stock. Looks really good. All right, let's mix in that Tesla request along with GM. Then we'll mix in the NU. All right, so Tesla. So Tesla is really just taken off with the news that Donald Trump won and Elon Musk was part of his effort to become president. And now Elon Musk is going to both be very influential and have access to a lot of power with the federal government. So that's most definitely going to help his company. The stock's just really flourished, needless to say. And the last month, it's up 22%. Year to date, it's up 70%. The stock has had some ups and downs along the way. So the stock's offered opportunities to buy into the stock. And with Tesla, there's always the philosophical question: are they a car company or are they a technology company? And I think anybody who invests in the company, they believe, no, they're more of a technology company that's going to come out with really incredible products. And I can't argue with that. I think Tesla is pretty amazing. If you think they're a car company, it's really hard to get the valuation of Tesla up because they don't make a lot of money. Let's take a look at their financials. So the market cap's they're up a $1.38 trillion, and their revenue is $97 billion. PE is really high. Forward PE is even higher. And they're all betting on, hey, Elon's going to get a lot of things out of his involvement with the president, and he's going to be able to really benefit from that. The revenue growth, they have had a tough time growing. They had a negative quarter in Q1. It's gotten a little better. But in general, the growth is not really exciting. And they are fairly big now. 97 billion is a pretty big company. We look at their gross margins and free cash flow. Gross margins of 18%. That is not a technology company. We just saw that EVVTY, that develops games for casinos and so forth, they have 100% margin. Tesla has 18. That's not very good. And when we look at their free cash flow, it's 3.6 billion. So even if it was a high growth company, maybe I can get the valuation up to about 100 billion, maybe 150 billion, but I can't get nowhere near 1.38 trillion. The numbers just don't add up to get to that valuation. Now, if you abandon the fundamentals and say, no, I just believe in Tesla and they're going to be great. Hey, I can't argue with that. The stock's been working for those folks. But the numbers do not support that valuation. They don't support the stock price. On the other hand, what is interesting is you have companies like General Motors, and you're going to see that General Motors has tremendous fundamentals, but their stock just can't, go up like Tesla has gone up. Over the 1 year, this stock, I think, has done well, 46%. Over the 5 year, up 41%. So really, it's about buying this stock at the right times and then owning the stock during 2024 would have been a great idea. 57 billion in market cap. They are about twice as big as Tesla from a revenue standpoint. PE 5.68. Holy smokes, that's outrageously low. Forward PE is also going to be low. So analysts think it's discounted. In the case of General Motors, they have terrific fundamentals, but the market just doesn't like legacy car companies. And really, I can't blame the market. There's nothing exciting about a car company. Their gross margins, look at that, 12. Tesla is better, but the car business is just not a very profitable endeavor. At 12% margins, that's just not very good. General Motors does have good free cash flow. I could value the company at their current valuation. I can definitely do that. This is a value stock. General Motors is a value stock. And I forgot to check on their growth. Revenue growth has been pretty good. Just green on the screen, good growth. It is a value stock, and it really has done well for a year. So congratulations to those that own General Motors. I don't think that they're going to do all that great in 2025. I think the car business just keeps getting harder. And next year, there's competition from all places. And internationally, the Chinese are making cars that are pretty darn competitive. So the car business is going to be tough. And General Motors does not have the luxury that Tesla has, which is their credibility from a technology perspective is just so high. They could venture off into other businesses and say, hey, we're going to be an AI company. We're going to be a robo-taxi company. And the market believes them. I don't personally invest in Tesla. I think there's just too many hopes and dreams in a stock, where I like to see some reality in the actual company. For example, the robo-taxi. Tesla doesn't have one robo-taxi in operation. They're working on it, but there's no single car that's doing it, where Google's Waymo service is already operational in multiple big cities. So they have a real business and are really leading the pack when it comes to robo-taxi. So that's Tesla and General Motors, two different investments. I'm not investing in either one. I don't like investing in car companies. I think there's other industries and sectors that I like that are far more profitable, that I think are going to make me a lot more money in the future. So I'm going to stay away from both, but I'll congratulate investors in both companies. If you're a Tesla investor, you did great this year. If you're a General Motors investor, you did phenomenal. So congratulations to both. And Axel, thanks for asking. I appreciate it. Thanks for attending. So let's keep rolling here and take a look at what's next on the list. So MSCI. So MSCI Inc., together with its subsidiaries, provides critical decision support tools and solutions for the investment community to manage investment processes worldwide. The index segment provides indexes for the use of various areas of investment process. Okay. Okay. And the stock's only up 7.67%. Over the 5-year, it's up 133%. It looks good. So it's gotten it done over the 5-year. This past year, it's been okay. It hasn't been a good year. For some reason, it really sold off in the April-May timeframe. It's a $47 billion market cap company, $2.8 billion in revenue. And PE is pretty high, 39.7 current year. And then the forward PE would be 36 for the next year. Provide a small dividend of 1%. All right. Analysts think it's fairly priced, discounted by about 6.8%. They're growing really nicely. 16% growth on a revenue number of 2.8 billion looks good. Yeah, the growth looks really good. All right. A lot of green on the screen. Looks good. And markets have been just doing great, right? Needless to say, a lot of stock values are up. A lot of investing going on. Gross margins really high, 82%. Beautiful. And free cash flow has grown over time. It's at a very high level. Now, this company, let's take a look at their balance sheet, but I'm thinking it's worth about 45 billion. But let's take a look at the balance sheet to make sure they don't have a bunch of debt. And they have about $497 million of cash and $4.6 billion of debt. Net about $4.14 billion of debt. EBITDA is 162. So they could pay off debt in less than 3 years. So it's a good balance sheet, not as good as some of the others we've seen because they do have some debt. Overall, I think this company is worth about $40 billion. So I think it's fairly priced, and not an exciting proposition. It's just a good company, but I think the stock price is currently priced at the right level. Maybe the market knows that, and that's why it's been somewhat trading sideways. So MSCI looks okay, fairly priced, but not. We're not looking for fairly priced. We're looking for great opportunities that are going to surprise us to the upside, that are going to surprise us in the middle of 2025, and boom, we make 50%, 75% on the stock. And I don't think MSCI is going to do that unless I'm missing something. But that is MSCI. Interesting company. Yeah, haven't looked at that one, so I appreciate you bringing it up. All right, let's take a look at New. That's Nucor. This is a steel company. Steel and steel products. These guys have been. Are these guys the ones that were in the news that a Japanese company wanted to buy them, but it's being blocked by the administration? Let's take a look. Yeah, probably. So they were really going up, and then they've really been dropping off. Okay, so Nucor, 27 billion in market cap, 31 billion in revenue. This is a commodity-based business, steel and other products. PE is 11, forward PE is 18. It's not an overly exciting business. It's very old, and we'll take a look at their margins in a bit. They pay a dividend. It's decent. I'm not a big dividend investor. I'd rather get a nice return of appreciation in a stock versus a dividend. That's what I'm after. Analysts think it's really discounted by 49%. We'll take a look. All right, so sales have been going down. So that is not good. And the sales have been going down for some time quarterly, if you look at the quarters. And I think it's that commodity prices have really settled down. And, commodities are going to drive Nucor's profitability. If they can sell steel at a higher price, they just make more money. Those tariffs may be a good thing for Nucor, because if you raise the cost of steel or the price of steel, Nucor is really going to benefit. Their gross margins are 15. That's a reason why I do not invest in steel companies and commodity-based businesses. Is the margins are not very good. We get to invest in any stock in the stock market, thousands of choices. And I'd rather choose, stocks that have really good margins, and just try to find them when they're discounted, or maybe find them when they're little companies that are growing, and stay away. And my decision is to stay away from companies like this that, things can really go bad for a company like this. If things go wrong, they don't have a lot of margin to fall back on. Their margin is really low. Free cash flow's there, but you can see that free cash flows was really high in 2022. I think steel prices were higher. 2023 is also good, but now it's really come down. So could I get to their valuation? Probably. I don't think it'd be tough to get there, because this is a very old business. It has some cash flow. The gross margins do not look good to me. I'm willing to bet these guys are also carrying some debt. It's just an old business, and they have to borrow money. So not too bad. They have cash of 4.86 billion and debt of about 7 billion. So they have about $2 billion of debt. That isn't too bad, because their EBITDA is almost 5 billion. So they can pay off debt very quickly. They have a strong balance sheet, but they're just in a business that it's in an industry that I just don't like. Margins are too low. Maybe you make a little bit of money for a year. You could see that, boy, things can go really rotten, huh? The 1 year looks terrible. And the 5 year, hey, this stock's really getting it done. Go Nucor. And somebody who really wants to be passionate about steel companies, this isn't a bad stock to look at. I think we can definitely get to this valuation. I don't think it's all that far out of sight, and it would be a good investment. I'm picking the sectors that I'm going to invest in. And for me, my strengths are in like software and those types of businesses. I'd rather be a specialist in a couple sectors and invest there rather than trying to spread the field. I have dabbled in steel, and it wasn't a disaster, but it just really was not a good idea for me. I made a little bit of money, but I just didn't feel like I was really able to pick the best companies and know when to buy and sell. So I'd rather just stay out of this space and let others invest in steel. Analysts, how many analysts cover this company? 8 of them. 8 analysts cover the company. They all think it has a price target that's higher. That big price drop in the stock for the past couple months is really creating potentially an opportunity for somebody that wants to buy into this company. The revenue is supposed to go up a little bit. And again, if those tariffs come in and raise commodity prices, Nucor is going to benefit because higher prices mean Nucor gets to charge more. They're going to be more profitable and generate more cash. So one thing to think about when you're looking at Nucor. Earnings per share is going to expand nicely. So things look really good for Nucor. So good looking company. You know, everything that's really working is in technology and communication services and financial services. This is kind of an old school company that's part of our economy that's been getting it done for 100 years. So hopefully they continue to do well, employ a lot of people, give them good jobs to make money for their families. All right. So Android PC, thanks so much for joining. You were part of my morning session. I appreciate you showing up, and you're part of the evening session. Thank you. So we went over that. Looks like Krishna, you were interested in Progressive and KNSL. So let's take a look at those. I know Progressive has been a real winner, and I'll tell you about my new favorite insurance company. I do invest in insurance. I like insurance. I think the insurance business is really lucrative. Warren Buffett likes insurance. He really likes insurance. I think he ended up buying all of Geico. So you see the Geico commercials, that's Warren Buffett's company. These guys, excuse me for coughing. I've got a cold, so forgive me for coughing in your ear. 52%, that is getting it done, ladies and gentlemen. 52.77%, and then they give you a 2% dividend. Not bad at all. Very good. Progressive Insurance is $141 billion market cap, $72 billion in revenue. The PEs look just fine, 17.5. Man, compare that to Palantir, that's like, I don't know, 100 and some odd. I think they're up to like 300 or something. It looks pretty darn, reasonable. And part of it is, the insurance business had to get their pricing right because car prices just went through the roof. Used car prices went through the roof, and it really squeezed their profits. But they got their pricing right, and now these guys are growing really nicely. Progressive did better than Allstate. I own Allstate. I did well with Allstate, but Progressive was the horse that really won the race, in my opinion, within insurance. And you could see that return was really favorable. Now, these guys are going to keep rocking and rolling and really having their stock price go up in value and rewarding investors. Well, let's take a look at it. Now, in the insurance business, you're not going to see huge margins because it's insurance. But they do get to take the capital or the cash that's being paid in form of premiums and then invest that money. So they make money a couple of different ways. And their free cash flow is really exciting. Look at this, 14 billion. Ooh, that's a lot of cash. So if I take 14 billion and say, hey, I like this high growth business, I can value this company 200 to 250 billion. I could really see a discount on Progressive. So Progressive looks beautiful. Great looking stock. Good job, Progressive. Good job to anybody out there that's been a Progressive stockholder. And the insurance business was a good business to be an investor in. And I'll show you a couple companies. I'll reveal the one that I'm going to start buying into. Progressive is out there. Allstate did well, but didn't do as well as Progressive. And Chubb. Warren Buffett started investing in Chubb here in the current year. Progressive won the battle of the insurance companies from a return perspective. Allstate came in second place. So you can have a little sympathy for me for not picking the number one player, but I'm going to be all right with a 40% return. And Chubb is kind of lagging, but when I look at Chubb's fundamentals, I'm seeing tremendous value, and they are also growing faster than Allstate, and I think they're growing faster than Progressive. So I'm seeing a lot of stars lining up for Chubb. So I'm actually going to switch horses and go from Allstate to Chubb in 2025. I don't want to do it now because if I sell my Allstate, I already have a pretty good tax bill I'm going to be paying with all the gains that I've taken here in 2024. I'm going to just wait a few weeks and then put this into action and move from Allstate to Chubb. So that's what's going on for me in insurance. And Progressive was a really good winner. I think it could continue to flourish because Progressive just has very strong business. Now, Progressive is in auto insurance and homeowners insurance and that kind of thing. It's nowhere near the health insurance business, which is the United Healthcare business. And that's important because obviously that business is really getting hammered. A lot of things going on there that are really negative. So it is not in that part of the business. All right. So we talked about Progressive. And then what's KNSL? Kinsale Capital. Never heard of that company. KNSL. Kinsale Capital Group. Specialty insurance company engages in the provision of property casualty insurance products in the United States. So they sell insurance. Now, are these guys underwriting the policies or are they just selling them? It's important to know because it would be the value of the business would be different. They're getting it done 39% for the 1 year. That is getting it done, ladies and gentlemen. Market cap, $10.8 billion. Revenue, $1.5 billion. P is a little higher than Progressive. Their growth is really good, 36. Now, they are smaller than Progressive by a pretty good margin. They're smaller than Chubb. They're smaller than Allstate. These guys are getting it done. Look at that growth. And let's take a look at those margins. They are very profitable. So these guys are growing faster. They're smaller, have better profit margins. Their free cash flow is really good. This company, you can value 25 billion in market cap, and they're a $10 billion market cap. This one looks really good. So Kinsale, I've never heard of these guys. So Kinsale Capital. Their website is not the nicest website I've ever seen. Don't want to poke fun at them, but guys, come on. Get an intern and have them make it nicer. They're in Virginia. And interesting. Okay. If you want to see like a terrible website, go to Berkshire Hathaway. Their website looks like they just gave it no effort whatsoever. And it's a $1 trillion market cap company. It's like, come on, guys. Hire a couple interns. Make the website pretty. This is a really interesting company. In insurance, it's a very fertile market. These guys are, making money across the board. All the companies are making money. This is an interesting little company. I'm gonna put it on my watch list because Chubb, Allstate, Progressive, those are known commodities. Now, these small companies are really standing up tall. And when you have a smaller market cap, you have a better chance of getting a multi-bagger. Like this thing turns into a $50 billion market cap. You wheel along for the ride and they multiply your money times 5. Now I'm okay with that. I am perfectly fine with a company taking my hard-earned money and multiplying times 5. I am okay with that. And this company has that type of potential. Got to do some homework on it, figure it out, see if it's a good investment. But it looks good. I appreciate you bringing it up. I think insurance is a pretty fertile space, and I like investing in insurance. All right, so we're covering a lot of ground. We went over. All right, so Krishna, thanks for attending, for your questions. Axel, thanks for joining. Android PC. Krishna, you want to see Fix, Axel, TS? Are you looking for TSMC or TSM, the company? Okay, so I think you are. So we'll look at TSM. So Fix, what is Fix? Comfort Systems. Comfort Systems, together with its subs, provides mechanical and electrical installation, renovation, maintenance, repair services in the United States. Okay, so they do air conditioning, heating, and ventilation. Okay, 16,000 employees. So these guys are a service company. They depend on providing services. And they probably do a lot of commercial installations where, a big company needs to put in, heating and ventilation and so forth. All right, $141 billion market cap. Oh, looking at the wrong one. I am looking at the wrong company. I thought we were already. Oh, here it is. Sorry. I was off on the wrong tab. So this is a services company. Look at that, up 109%. Wow. Wow, this company is really exciting. Just crushing it. 15 billion market cap, 6.5 billion in revenue. PE is a little high. Forward PE is 26. So the market really likes this company. They do services, and they're probably an industrial company. They're probably in the industrial sector. They're growing really fast. The growth is really exciting. Looks really good. 31% looks really, really good. And if you look at the quarterly, they're getting it done quarter after quarter. Nice job, Comfort Systems. I'm sure they got a lot of momentum. They're doing really well. Good for them. Gross margin, their services outfit, so 20%. Okay. Free cash flow, 715. And okay, so you don't get that much cash. You don't get that much margin. So 715, I could probably value this company at 15 billion. That's exactly where they're valued. The market has put them right on where I would think I would value the company. And cash, debt, they have no debt problem. They have more cash than they do debt, so that looks good. I mean, they've gotten it done for the 1 year and the 5 year. Just phenomenal business. I mean, how that is exciting. Congratulations to this business. But I think the stock is priced fairly now. And these guys can't grow without putting more capital into the business. And as they grow, they have to grow their cost model. It's not like they, license something like a pharmaceutical company owns a drug. That drug's really successful. So 10 million people buy it. Well, they don't have to spend much in manufacturing that drug to sell it. These guys, they have to install or service the air conditioning and heating systems for these residential and commercial buildings. And they have to put the money into the actual service, providing the service. So it's an interesting company. It's phenomenal what they've accomplished. But I just don't see that they're going to continue on this path. It's not a business that I want to be an owner in. This is an industrial engineering construction. These do not drive like extreme valuations. Like, hey, there's an engineering construction company that's $1 trillion market cap. That doesn't exist. Maybe there's one that's maybe 100 billion, but there's just not a lot of value driven there. So I'm not in that sector, but obviously people that have been in this stock have been doing great. Congratulations to those that have. Fundamentals support this stock price, but I don't see much upside from there. All right, so let's look at TSM. TSM is Taiwan Semiconductor. This is a very important, powerful company. They've done well for the 1 year, up 100%. For the 5 year, up 257%. Awesome. I love TSM. I invested in TSM a while ago and made good money. I think I tripled my money and then got out. So I got out before it settled down here. I was glad I did, but I like TSM, but I haven't been an investor since I sold in early 2022 or so. And these guys are getting it done. TSM is a really important company. NVIDIA depends on TSM to manufacture and make the GPUs that they sell that the market really wants. Broadcom is the second most valuable semiconductor company. They depend on TSM. Probably a lot of the semiconductor companies that are really, really valuable depend on TSM. They are the foundry, the manufacturing aspect of semiconductors. And credit to them, they really said, hey, we want to be the semiconductor leader in the world. And they set up their operations. They have recently started, they've either completed, near completion, of a big foundry they built in Arizona. So hopefully that goes well for them. Market cap's 855 billion, revenues 83 billion. PE is 26 for the current year. Forward P is 19.37. The revenue came down a little bit in 2023 quarterly. They've been really growing nicely in the last couple quarters. Looks real good. This industry tends to be cyclical. There's a boom and bust kind of cycle to it. Looks like the bust is behind them. And this is looking good. All right. So revenue is growing at 22%. And we just saw that the quarterly is growing at 40. So it's probably going to get better than that if we look at the full year. And the gross margin is 54%. Not quite as good as like an NVIDIA, because NVIDIA owns the intellectual property that goes into their GPUs. So NVIDIA's gross margins are better. These guys are at 54. That's still very good. Free cash flow. And let me see if what kind of currency we're dealing with. This is the Taiwanese currency. So TWD. And I'm going to try something. So the stock analysis website converts the numbers to USD. And the free cash flow for the trailing 12 months is 25.5 billion. Looks really good. The growth is really, really good. And balance sheet is 68 billion of cash, 32 billion of debt. So they have $36 billion just in their vault, in their accounts. So very strong balance sheet. Overall, this business is worth 750,000 or so, 750 billion, excuse me. And they're priced at 855 billion. I believe I have TSM as a company where I've done a full valuation on, and I believe they're No, I don't, because I guess I stopped following them. So I think they're overpriced by a little bit. Analysts think they're discounted by 10%, and they've been going up nicely, up 100%. Go TSM. So in the semiconductor space, the company that I own is Qualcomm, and then the one that I'm going to probably start buying shares in is Lam Research, because what I'm seeing from TSM is that volumes are going up. Well, Lam Research is also a provider of semiconductor companies. They provide infrastructure as well as the materials they need to build semiconductors. So I'm seeing that that market is quite fertile. We look at the quarterly and TSM's doing these kinds of numbers. That means the industry's pretty active. So I think Lam Research is going to be a stock that I buy. So that's TSM. TSM looks awesome, but it is priced very high. It's not a part of, you don't make money from buying, companies that are really cool. You make money by buying companies at the right time. They could be cool, but they also have great fundamentals and they go up in value. TSM is getting it done. Very good investment if you bought them and held them for the past year. All right. So we're getting through the list. Looks pretty good. If you guys want to talk about any other stock, let me know. All right. So there is a stock that I wanted to finish researching, and it's Pags, Stone, and SentinelOne. This is a software company. These are labeled as software infrastructure companies, but I'm not convinced. They're more like payment system companies. So let's go take a look at. Let's start with SentinelOne, and we'll compare that to Zscaler. So Zscaler is in the same industry as SentinelOne. These are software companies that help with security. So you can have a secured computer. You can have the computers at your business, servers, and so forth, nicely secured. All right, so SentinelOne. All right, so these guys for the past year down 18.85%, which is interesting because they're in security software. And if you look at CrowdStrike or Palo Alto, they're doing really, really well. But these guys are kind of being left behind, which is an opportunity in my mind, potentially, to buy a company that's being unappreciated that is worth something. Analysts think it's discounted by 31%. All right, so let's take a look at their fundamentals and update my valuation spreadsheet and see where these guys are going to land. So free cash flow, this is what's going to be tricky about this company is their free cash flow. It's hard to gauge because it's the trailing 12 months is the first time that they've been cash positive. In the past, they've been cash negative. But we see in one quarter, they have 41, 175. Yeah, this is hard to determine what's going to be the cash forecast. And I try to forecast cash, and I can't do that with SentinelOne. I don't have enough information. So I'm going to have to cancel that one. I'm going to have to abort. All right, so we'll abort this guy. It is a successful failure. And that guy is now off my radar. Next company I want to look at is StoneCo. And StoneCo is a lot like, similar to PayPal. They do payment processing, and they're really, really good down in Brazil. So I'm going to look at StoneCo and compare it to PayPal and see what they look like. So I am a PayPal stockholder. PayPal has been working this year. Glad. I think PayPal is a good company. They've been growing nicely. They're still nicely discounted. Now, the two companies I'm looking at are down in Brazil. And I don't have a lot of, I'm in the US and I don't have a lot of investments outside the US. So it's not a bad thing to be diversified a bit. I'm still going to own most of my assets here in the US. But when I look at investments in like StoneCo, it's not a bad idea to diversify outside. But I want a higher rate of return. If it's going to be higher risk, I want a higher rate of return. So my discount rate is going to go up. So before I adjust my growth rates, let me try to get a good cash forecast started. Trailing 12 months of StoneCo. So these guys, just a quick tour. They provide, it's a fintech play. And if you are down in Brazil, Mexico, and Latin American countries, StoneCo provides the means to receive payments at your restaurant, on your website, and so forth. The market has not been kind to them. It's really torched the stock. But at one time, this is just rocking. Look at that, $92 a share. So there is the potential. Now, I was looking at these charts comparing StoneCo to PayPal. And PayPal as well really got bid up around the same time as StoneCo. And it's interesting to see that the charts are similar, but I wanted to show something. So you see that PayPal and StoneCo in 21, they're both flying high. You know, PayPal flew much higher, and then they both settled down. But you see here, they're really separated. PayPal is beginning to work. PayPal's up 39% for the 12-month. The StoneCo's hasn't rallied. And I'll show you that the revenues are still good. They're still growing. So maybe now's the time to buy StoneCo and expect that they're going to start to rise like PayPal has been rising. Let's take a look. So StoneCo, 2.4 billion in market cap, tiny market cap. If the market starts buying into this stock, it's just going to fly up because it's so small. They are 2.27 billion. PE is 6.85. That is ridiculously low. 100% discount. Holy smokes. Man, what a discount. And when we look at their growth, they have been growing their revenues. This is in the BRL, Brazilian currency. And quarterly, looks like growth is slowing down a bit. Yeah, growth is slowing down a bit. It's still green on the screen, so that looks good. And they have negative cash, but in previous years they had positive cash. And they're about a $2 billion company. So the profit margin is low. So this is a little bit concerning. This is kind of low. All right. So let me look at PayPal really quick and look at their profit margins. It looks like the football game's going to start in Lambeau Field. And I forgot who they're playing. But I'll soon see. All right. So here's PayPal. I want to look at the gross margins. Gross margins of 40. See, that's way better. So StoneCo on the gross margin line, I don't like it. Don't like it at all. And then it's up and down, not consistent. So that's weird. Why is it going up and down? Okay, so negative cash. And if I look at the quarterly just to see how that cash flow has been going from quarter to quarter, negative, negative, negative. Man, these guys are in a little bit of a tough time. Well, too many red flags. I've worked too hard for my money to take a chance on these guys. So StoneCo is going to be voted off the island. Sorry, guys, but we're going to take you out. Let's look at PAGS, which is similar. We'll see if PAGS is going to stack up well enough to be a stock that I will follow. And so PAGS, what was their name? I think if you pronounce this in Brazil, they speak Portuguese. In Portuguese, it sounds better. PagSeguro. That's not Portuguese. That's Spanish. All right. So that's PagSeguro. All right. We'll keep that nice high discount rate. And let's take a look at their financials, see what's going on. So they're growing really nice. That looks good. Gross margin. Wow. Gross margin's way better. Very good. So PagSeguro is looking good. Free cash flow is bad. Let's look at the quarterly, see how that breaks down. So this is one that this one I'm gonna follow because if they get their business right, and I think PagSeguro, you can add it to the so if we look at PagSeguro, it's right there with StoneCo, separating itself from PayPal. You can see that these things kind of traded together, and now PagSeguro and StoneCo have separated themselves from PayPal. Now, thinking PagSeguro may join PayPal if they operate really well and the market likes them. The one thing that I'm looking at with PagSeguro is they're a tiny cap. If this stock moves, man, look out, 2 billion. So let's take a look at their statistics. That's where I'm going to get my free cash flow and put it into my model. And so balance sheet, they have 132 million. Okay, I'm going to get that later, but see, they have negative cash. All right. So for now, I'm just going to keep it on my watch list, but I'm just going to keep watching it. I can't value it because they have negative cash. Maybe the next quarter, they're going to give me better financials. I'll be able to do a full valuation, but for now, it's just going to be a watch stock. Those are interesting little companies. I like getting into companies early and then making money. I think it's fun, gratifying. I think PagSeguro is a stock that I want to watch it, and their next earnings is in February, and I want to watch it and see if the next earnings call to give us positive news on free cash flow that I could then kind of put a better forecast out there for them. Maybe watch it for 2 quarters and then make a decision. All right. So Arista Networks is eating Cisco's lunch, just beating them up. So there are some beaten down stocks. Zscaler is probably a stock I'm going to buy. I'm going to buy it here in 2025. ASML looked pretty good. LRCX is a stock I'm going to buy, and that is Lam Research. So I'm going to buy Lam Research and Zscaler in the list that you put in there. New Holdings looks interesting. What am I going to do with New Holdings? I'm probably going to buy some New Holdings. So I think these are beaten down. These are beaten down. So I'm going to get into some Chubb and KNSL looked really good as well. Lantheus looked great. This came out of the community. Some member of the community has been looking at this stock. I think invested in the stock. It's doing great. It's a biotech company. So there's always good buys out there. It just gets a little tougher because, the market is really done well. It's up 119% over the 5-year. And since we had that nice correction in 2022, the NASDAQ's up 88.8%. So it just gets a little harder to find, good discounted stocks or good stocks that are priced well, that are growing really well. But they're out there. You just got to do some homework and find them. Right now, I'm kind of careful. I'm actually growing my cash position. There's nothing wrong with having some cash right now. If we have another event, kind of like the one we saw a couple years ago, I'll be glad that I have cash. Here, it started late November 2021, ended around at the end of 2022. It was a 34.8% pullback on the NASDAQ. This was a tough correction. It was a good correction. A lot of money to be made on discounted shares. And now we've been on this party, man. It's been like the buffet is unlimited. Go for as many trips as you like. Eat as much as you like of whatever you find to be tasty. And I just think the environment's a little too rosy. And we'll see when we get a nice pullback, maybe in January, when a lot of investors are waiting to sell in January so they don't have to pay their taxes, which is the case for me. I'm holding off from selling some stocks in December because I don't want to pay the taxes this year, or I guess sell it in December and then pay my taxes in April. If I could just wait another month, I could postpone the paying of taxes by a whole year. So that's not a bad idea for me. And hey, Anirudh, thanks for joining. Really appreciate it. Krishna, thanks for all the questions. Good stuff. All right, so I think I'm running out of stuff to talk about, and it's been a really nice live stream. I appreciate the questions. And what's cool about live streaming at a different time is, there's some names that either haven't seen for a while or maybe are seeing for the first time. So it's good to be exposed to you guys and you guys be exposed to me. My channel is about just, one investor looking at companies, investing, and I have a portfolio of stocks and just sharing with the knowledge, the information. I also have some tools that I've created, like the Google Sheet you saw. I created that, and I provide that to paid members. So if you want to be a paid member, there's a $10 program, I think a $25 program, then kind of a VIP at $100 a month program. So if that's interesting to you, you can get signed up. The details are in the description of the live stream, but it's not required to attend the live streams. You can attend live streams and put in your comments, be a part of it. We also have a good Discord going, and those details are in the description of the live stream. And the Discord is really active. A lot of good investors are on that Discord. So you may want to take a peek and see if it's something that's going to help you. So that's what's going on in my YouTube channel and the community that is built around that YouTube channel. All right, guys. So it's been a really nice session. Thank you again for tuning in. I appreciate it. And let me wish you a very nice week. Happy holidays to everybody. and hopefully you get together with friends and family. You have a good time. I'm going to try to do that. I'm dealing with this cold, so I got to stay away from people so I don't get them sick. But once I'm not contagious, I'm going to be sure to spend time with the people that I care about. All right, everybody, let's see where the market goes tomorrow. I'll try to live stream again tomorrow evening and hope to see you at that time. Take care, everyone.